Welcome to Talk Tickers. Today we're digging into Renasant Corporation's Q4 earnings. Now, after a massive merger, all eyes were on this quarter to get a clean, honest look at the company's health. And you know what? It was pretty darn impressive. Right out of the gate, the CEO, Kevin Chapman, set a really confident tone. He basically framed 2025 as the pivotal year, the one where all the hard work from their huge merger finally started to pay off and hit the bottom line. The message to investors was loud and clear. We told you we could do it, and we did. And it looks like the market agreed. The stock jumped over 3% right after the call. That's a really strong signal that investors aren't just listening to the story, they're buying it. All right, so let's get into it. What exactly did Wall Street see in these numbers that got them so excited? Let's break down what drove that reaction. Well, first off, it was just a decisive beat across the board. I mean, look at that earnings per share. They didn't just sneak past expectations, they absolutely crushed them by almost 17%. Revenue came in strong too. There's really no other way to slice it. This was a powerful quarter. But here's the thing. The real story here isn't just the beat itself. It's what's happening behind the scenes. This performance is all about them successfully integrating the first merger. The cost savings they promised, they're real now, and they're flowing through. This has completely shifted the narrative from merger risk to merger success.
And this number right here just proves the point. Management made sure to highlight their return on assets, which jumped up to 1.29%. That's a 20 basis point increase from just last quarter, and it shows they're getting way more profitable with the assets they have.
And this one? Even more impressive. The return on tangible common equity, which is basically the profit they squeeze out for every dollar shareholders have invested, it surged to over 16%. That is a massive 200 basis point leap in a single quarter. For shareholders, this is a key metric, and it is going exactly in the right direction. And crucially, they achieved all this without taking on a bunch of risky debt. The bank's credit quality stayed rock solid. Yeah, there's a little bit of noise in the numbers from a one-time loan sale, but if you look past that, the underlying picture is one of real stability. So they definitely ended the year on a high note. But what about 2026? What's the game plan? Let's take a look at how management is positioning the bank for the year ahead. The official guidance is all about steady, controlled growth. They're aiming for mid-single-digit loan growth, but the real focus, the thing they kept hammering home, is a stable net interest margin. That's the core profit they make on loans versus what they pay for deposits. And in this economic environment, that margin is absolutely everything. Okay, so the bank is making more money and the balance sheet is strong. Naturally, the next question on the call was a big one. What are you going to do with all that extra cash? And management was refreshingly clear. Look, growing the business organically is always priority number one. But right after that, they explicitly said share buybacks are the most attractive way to return capital to shareholders right now. So while another merger is still on the table, buybacks are clearly front and center. And what makes all this possible is their super strong capital base. They plan on keeping their CET1 ratio, which is just a key measure of a bank's financial strength, right around 11.25%. That solid foundation gives them the flexibility to make these moves without taking on unnecessary risk.
Now this is where it gets really interesting. During the Q&A, a subtle but pretty powerful catalyst came to light, a potential earnings tailwind that's already baked right into their balance sheet. So it turns out, Renasant has about $1.3 billion in fixed-rate loans on its books, currently earning around 5.25%. Well, those loans are set to mature and reprice soon. As they roll over into today's higher market rates, that could provide a really significant, almost automatic boost to their income all year long.
So let's put it all together. The strong order, the clear guidance, the positive market reaction. What's our take on the stock from here? You know, the investment debate here really boils down to a classic bull versus bear setup. The bulls are focused on the fact that the merger is a proven success, costs are under control, and you have these great catalysts like buybacks and loan repricing. The bears, on the other hand, are worried about bigger industry-wide problems, margin pressure, funding costs, and of course, the risk of a slowing economy. So, what should you watch for at the next earnings call? We're predicting another solid quarter for earnings, probably meeting or slightly beating expectations. But honestly, the entire narrative is going to hinge on that net interest margin. Can they keep it stable? Until the market gets more proof on that, we think the stock will probably trade in a range. Given that strong execution in the fourth quarter and the very clear path management has laid out, we are assigning an outperform rating to Renasant. Our thesis here is pretty straightforward. The biggest risk, that tricky merger integration, is now firmly in the rearview mirror. The company's profitability is clearly trending higher, and we just don't think the current stock price fully reflects its new earnings power or those near-term catalysts from buybacks and loan repricing.
Look, Renasant proved it can execute a really complex merger. The big question now is whether it can navigate the choppy economic waters just as skillfully. We'll definitely be watching. As always, remember this analysis is for informational purposes only and is not financial advice.